What you are witnessing right now is not a market accident, not a random sell-off, and definitely not the end of silver's move. This was a precision-engineered volatility event, designed to shake confidence, force emotional decisions, and transfer metal from weak hands to strong ones. The silver market did not collapse, it was stress-tested. And if you felt confusion, fear, or doubt over the last 24 hours, that means the mechanism worked exactly as intended. Because real bull markets do not move in straight lines. They move by exhausting belief before rewarding conviction. At the open, silver didn't rise. It teleported. Price launched into the low 80s with almost no resistance, printing a new all-time high so fast that most traders didn't even have time to react. And that alone should have told you something was wrong. Healthy markets don't gap vertically in thin conditions. That kind of move is a flare shot into the sky. It attracts attention. It pulls in breakout traders. It invites leverage. And once that leverage is in place, the trap is set. Within hours, price was slammed down nearly $9. Headlines screamed crash. Social media exploded. Retail panicked. But professionals saw something very different. They saw a textbook stop hunt executed during one of the lowest liquidity windows of the entire year. Ghost Week. The dead zone between Christmas and New Year, when desks are empty. Volume is thin, and algorithms have absolute control. This wasn't selling pressure. It was liquidation engineering. Price was driven deliberately through known stop-loss clusters, forcing margin calls and automatic sell orders to fire all at once. That forced selling created artificial liquidity, liquidity that institutional desks needed to accumulate size without chasing price higher. That's how big money buys in bull markets. They don't chase strength. They manufacture weakness. Look at the daily chart. That ugly candle everyone is afraid of. The long wick. The sharp rejection. It has a name. Shooting star. And in isolation, yes, it looks bearish. But markets do not exist in isolation. Context is everything. In a mature uptrend, a shooting star often marks a liquidity test, not a top. It tells you price moved too fast, too far, without enough volume underneath it. The market pulled back to see who would hold and who would fold. And the answer is now clear. Because while the paper price collapsed, the physical market didn't blink. Bullion dealers did not lower premiums. Inventory didn't flood the market. Delivery times didn't improve. The so-called street price held firm. That tells you everything you need to know. This move happened on screens, not in vaults. Paper contracts were dumped. Physical metal was not sold. That disconnect is not weakness. That is stress in the system. It means price is lying and supply is tight. And when price and reality diverge, reality always wins. Eventually, violently. This is why leverage is poison during events like this. Margin traders paid the volatility tax. They were forced out at the lows so someone else could buy cheaper. Holding physical is boring. It's slow. It doesn't feel exciting. But boring is how you survive engineered chaos. This wasn't about punishing silver bulls. It was about cleansing excess leverage before the next leg higher. The market needed to breathe. And now it has. Which brings us to timing. Because this didn't happen randomly. It happened at the end of the year, on purpose. Funds are flat. Books are being closed. Risk is being reset. And in just days, an entirely new wave of capital enters the system. Pension funds, institutional allocators, fresh budgets, fresh mandates. That's the January effect. And silver is positioned perfectly for it. The leverage has been flushed. The weak hands are gone. The structure has reset. And the narrative is now clear. This was not the bubble popping. This was the launch pad being cleared. Now the real question is what comes next, because this is where most people get it wrong. Many will look at today's recovery and assume it was just a relief bounce. They'll think the danger has passed and the excitement is over. But in reality, the opposite is true. The real move usually begins after the shakeout, not before it. There is a classic market structure known as the slingshot. Price breaks out, collapses back into support to terrify participants, and then launches higher with far more power than the initial move. What we just witnessed over the last 2 days was that pullback phase. The rubber has now been fully stretched. As the first week of 2026 opens, this will no longer be about reclaiming the old highs in the low 80s. Higher levels are now in play. Technicians will explain it with math. Silver spent weeks consolidating between $65 and $75, building a $10 base. When price finally broke above 75, the measured move projected into the mid-80s. That target didn't disappear just because price moved too fast on Monday. The market simply reset itself to reach it in a more sustainable way. This next advance will not be fueled by retail leverage. It will be driven by institutional accumulation. And that distinction matters, because leveraged rallies collapse. Accumulation rallies persist. Now zoom out beyond charts and into the corporate world, because this is the factor most retail investors completely ignore. January isn't just a new year, it's a budget reset. Industrial buyers don't think in headlines, they think in procurement cycles. Companies in electronics, solar, medical devices, automotive manufacturing, they freeze spending in December to clean up their books. And then in January, they restock. This year, they will be restocking into a market that is already undersupplied. Picture a crowd waiting outside a buffet where half the food is already gone. That's not inflation. That's scarcity. And scarcity forces bidding wars. When industrial demand collides with tight supply, price doesn't negotiate. It adjusts upward. Now add the banking system to the equation, because this is where the real pressure builds. Commitment of traders. Data shows that banks remain net short. They covered some exposure during the crash, but they did not exit completely. With price now stabilizing back in the mid-70s, their discomfort returns. In 2026, they face a binary choice: double down and hope for a miracle, or flip sides. And the moment a major bank turns from short to long, the signal breaks. That's exactly what happened in gold in 2019, right before a 50% rally. Silver is standing at the same doorway. Retail psychology, meanwhile, is being deliberately abused. Fear one day, relief the next. Exhaustion by design. The market wants you emotionally drained, ready to quit. Because stress is the admission fee to asymmetric gains. If this were easy, everyone would do it. Those who sold the lows are already regretting it. Those who held or bought the dip are now part of the foundation. This is how secular bull markets behave. In bear markets, rallies are sold. In bull markets, dips are bought. Look at the physical supply chain again. End-of-year refinery audits slow new output. Hedging demand remains high. Industrial demand doesn't pause. That creates a tight flow environment. One large buyer stepping in can force another gap higher, because there is no safety net beneath price. Add geopolitics to the mix. Elections, conflicts, cyber risk, currency instability. Smart money does not want to enter a new year holding only cash. It wants chaos insurance. Silver provides that. Buying silver at the end of December is a vote of no confidence in stability. And given the headlines, that vote is rational. The strategy is simple. Don't get clever. Fighting a trend usually costs more than following it. Scalping destroys focus. The trend is up. Fundamentals are screaming. Technicals have reset. $71 is now the line in the sand. Industrial buyers are standing behind you. On the monthly chart, a massive green candle is forming, breaking out of a multi-year base. History shows that moves like this last 6 to 9 months. We are barely in the first one. Don't walk out of the game in the opening inning. This is only the beginning. As January unfolds, new budgets, new flows, and new narratives will push price toward levels that currently feel abstract. The real question is not whether silver is $74 or $75 today. The real question is how many ounces you hold. Because the dollar is just the scoreboard.